Friends, let me welcome on board Vikash Kumar Jain, the investment analyst at CLSA. Vikash, hi, morning. Good to have you on the show. Hope all's well.
Morning. Hope everything's well at your end and safe, and you had a safe Diwali.
Right. Vikash, tell us about what exactly is the theme of the conference this time, and if you could give us some color on who are going to be the big star speakers.
So this time we've kind of take cognizance of the fact that this is an e-conference. So when we are trying to present our content, it's competing with not just someone sitting at home and spending time with their family, even with Netflix, even with their own work. So the content bit has to be pretty exciting, and that's what we've tried to do. We've divided the days into three parts. The first day, which was day before, was all about macro, where we had an ESG panel, where the NTPC chairman was there, where the Dalmia Dalmia Cement CEO was there. We also had then Mr. Sanjeev Sanyal present the macro picture as well. The second day, which was yesterday, was about disruption, where we talked about disruption in healthcare, talked about disruption in the auto sector, disruption in retail and FMCG, and disruption also possibly in financials. And today is all about post-COVID India, and we are looking at some of the older economy sectors and how they would possibly pan out in a post-COVID world, likes of real estate, likes of rural India, and likes of even banks, and how credit cycle will play out over there because of that. And tomorrow is an interesting one, where we present several unlisted companies who would be making their presentation. Plus, we have the Make in India theme also tomorrow. So it's pretty engaging content, I would say, because we take cognizance that we'll be competing with several things to gather attention or to catch attention of investors.
Indeed, quite interesting. Vikash, on the subject or topic which is being covered today, and I want to just pick your brain a little bit on that. We've already seen that the market is already making that adjustment. From IT, pharma, Reliance, money's already begun to move into cement, old economy names. Steel has been doing very well, and banks too are making a comeback. Do you think that these sectors are going to be the leaders of the next lap of the market move? And do you think this is where there is a beta trade as well that one can benefit from?
So yes, I think sometime in early October, we actually came out with a note titled Rotation Time, where that's precisely what we argued, where we said that, and this was based on a simple thing, that on two very powerful reasons. Number one was sometime in the middle of September is when India's COVID curve peaked. By early October, we were convinced that possibly this is a real peak and things are looking better. And as that happened, the focus shifts to economic normalization, that possibly we could get closer to the pre-COVID world. So that essentially itself meant that we will go, move to more domestic economy kind of stocks. What was very interesting is we divided our coverage into two kinds of stocks: COVID resilient stocks and the COVID impacted stocks. When we put this note out in early October, it was starting that the only theme that was in play during all of 2020 was whether a stock benefits from COVID or whether it is hurt by COVID. COVID resilient stocks had outperformed COVID impacted stocks by 45 percentage points by early October. And we were simply calling that this thing will reverse. So we were calling for movement toward banks, some of material names, some of some of infra names, essentially core economy sectors, as economic normalization plays out. It's pretty surprising how quickly it has happened. In fact, this note is not even 1 month old, and that 45 percentage point outperformance has now come down to 28 percentage point outperformance of COVID resilient stocks over COVID impacted stocks. So it's played out pretty quickly. That's because the COVID curve has seen a pretty dramatic decline, and that's something which is, again, in line with what we have seen in several countries, where once it peaks, the decline, because of the nature of the disease, that there is a 14-day element to the disease, recoveries kind of take place, and there is a significant decline. The other interesting point that we highlighted in that note, and which is also playing out, is there is a tendency for a big portfolio shift in the fourth quarter. So in the fourth quarter, we have seen, based on empirical data in the last 5-6 years, almost 60% of the best performing names, of the top 10 best performing names, end up underperforming in the fourth quarter. It's basically saying that if I were to say that somewhere, the IT, pharma, or some of the names that you mentioned, which were like the star performers till about 9 months, will underperform in the fourth quarter. That was a big call to take. And secondly, the reverse is also true. The 10 worst underperforming names actually end up outperforming, and 60% of them end up outperforming that. So there's a tendency possibly to kind of a mean reversion or booking profits in the fourth quarter. And I think that is also what made that tendency even profound is the fact that COVID curve was looking much better. So I think that's something which is at play. And I think that continues even going into next year when investors talk about portfolios for 2021. The key discussion would be economic normalization and the pace of it. And that's something which will keep these things going. So, some of that, even that 28 percentage point of outperformance that we've seen for COVID resilient stocks over the impacted stocks, some of that will further unravel in the coming months, I would say.
Quite an interesting pool that you've bifurcated names in, COVID impacted and then the COVID beneficiaries. But Vikash, to be fair, the COVID impacted pool, I would say, is much larger and vast than the beneficiaries. Where within this large pool do you actually hunt? We've already spoken about banks and cement to some degree. Where else do you find value?
So, I think the way to look at that is when economic normalization is playing out, then, what are the sectors that domestic core economy sectors. So essentially you could also pick and choose some of the infra names. And maybe there is, even the defensives, I would say with valuations being where they are, the other point that we'd also highlight is we believe that the larger beta part of the rally is, there's not much juice left in that beta part of the rally. That is, the index going, there isn't much juice left in the index. In fact, we did another report just last week, which came out where it was a cross-section view of our technical analyst as well as our fundamental view on 70 top stocks, where we highlighted that both our fundamental opinion as well as the technical opinion is that from a Nifty perspective, it'll be difficult for us to get even double-digit returns over the next 12 months. But the action will lie in this sector shift, which we are talking about. So maybe some of the infra names. I would also say that some of the utilities, that is the traditional utilities, would be preferred over the global defensives. Global defensives is done very well, but now we'll possibly come back to domestic utilities, and some of those names would also be interesting. Maybe it could be some of the power names. It could also be some of the maybe the gas names as well. So all of that would come back in focus. So even within defensives, there could be a shift away from the global defensives that we have seen.
Morning, Vikash. Wanted to understand your take on the IT basket as well, because the kind of commentary that we've heard from the companies on deal wins, their overall execution, how things have shaped up with a focus on digital, seems to be very promising. Add to that guidance as well. How are you looking to navigate within this space?
So, I think we like the IT space to some degree, but when we look at some of this, I think we need to bear in mind the expectations which are baked into these stocks. IT and pharma are two spaces. So when we draw this simple chart of sectors which are trading versus their historical average valuations, IT, pharma, and to some extent autos is what kind of clearly comes up right, at the extreme right quadrant where, very expensive. So expectations which are baked into these stocks is pretty high. So from that perspective, the big rally that we saw over the last 3-4 months, that kind of a strength will be difficult to replicate. Plus, I think there is an element of buyback-linked excitement, which will also, as that buyback kind of, a couple of buybacks in the sector, as that kind of plays out, there will be some of that cooling off which will happen. So yes, I think clearly the importance of IT has come to the fore with the pandemic, because imagine that we are still, a large part of us are still working from home. So uh, that part will be important. However, expectations itself are pretty significant. And more importantly, there was a period from April, May, June, where there was just this one large conglomerate which was seen as the only play on the on the street. Then we moved on to IT being the big play. So it's really because the options available for people to play the theme, which is economic normalizations, are so much wider. The dominance of a couple of these kinds of sectors will come down. So it's really, I think, why some of these sectors will not do as well as what they have done in the last 3 to 6 months is because now people are not so scared of investing in banks or investing in core economy stocks. So it's the relative attractiveness of these stocks and the theme that everybody is playing, which is economic normalization, which could really help some of these names.
The word when it comes to IT. What about, I know you spoke of utilities and infrastructure, but would the commodity space be something that can be explored, the metal stocks? Because you have seen some sort of attraction as well building up within this space on account of things opening up, restrictions easing gradually. The momentum here as well has been improving by and by. Would you venture into this space, or is that something, these commodity linked stocks, that you'd avoid?
So, that's something which would feature when I say materials. So I think, again, so we're not just playing a domestic economic normalization trade. We're also playing a global economic normalization trade to some extent into next year, with the hopes of vaccine rising. And this is the interesting thing, with the hopes of vaccine rising, despite the kind of spike that we've seen in cases in the US as well as in Europe, people want to kind of, in a way, the markets have not taken as much note of it as it should have. Had the hopes of vaccine not been there, markets would be very nervous of what is happening. So I would say that some of those names actually feature in that global economic normalization trade, and those are some of the sectors which could do pretty well as well. And I think we have a slight preference for the non-ferrous names over there versus the ferrous ones. But we like the material space in general, both the domestic material space as well as the international focused commodities.
Okay, Vikash, we'll leave it there. Thanks so much for joining us this morning, and all the best with the conference.
Thanks for having me.